Hello, folks. Brandon Chapman with today. It's a Monday video for September 29th, 2025. Is the market waiting for the hammer to fall? You know, that's a Queen song, The Hammer to Fall. It was in the movie Highlander. There can be only one. But as we're looking at the S&P 500, are we waiting for some event to happen this week? You know, the S&P is looking to finish up nearly 0.25% today, and yet the VIX is also going to finish up nearly 5%, almost 1 point to 16.13. I mean, how often do you see the S&P go up with the VIX? Recently, it's happened a lot more often. As we look at Skew took a big decline on Friday because this is an end of day data point. We went from like 145, 146 down to 141, which I guess makes sense. We saw a big decline in the VIX on Friday as there was a significant amount of selling, likely on the put side, which lessened the skew. It's going to be interesting to see with today's uptick in volatility. Do we see a new round of hedging and the skew index rising? Again, indicative of perception and also hedging that's going on. Well, how do they hedge? They sell calls and buy puts, which causes the volatility curve to go from more of a slope like this to even a steeper slope, which this is what it's measuring. The higher it gets, the more hedges are being put on, and the steeper the slope of implied volatility as you move from out of the money puts to out of the money calls. Well, as that's going on, we're thinking about, well, what events are there this week? Well, we do have a potential government shutdown on October 1st, which, you know, by itself isn't really a big deal. Government shuts down. How does that really affect the market? It doesn't. But in the past, it's been the resolution that ultimately has caused the market panic and ultimately some selling in the bond market. But today we're finding a bid in long-term Treasury bonds, 20 plus years. We look at IEF. We're looking at IEF going up as well. IEI, these are all different parts of the Treasury curve. We're seeing a bid in the Treasury market today. Now, again, this might be just being a bid in lieu of potential weakness in the market, but whatever it means, again, as we look right now, we're not exactly looking at a market that is poised to fall just based on the conditions we're seeing right now. So singularly, obviously, a shutdown is not going to create market turmoil, but the resolution might. What else do we have going on this week? Well, we do have some window dressing, right? So going into the end of the quarter, there's been a desire to want to hold Mag 7 companies. You know, we saw this last week as we saw it kind of turn and start to sell on Thursday, and then all of a sudden we saw the money come right back in again. We saw Staples trying to top the list only to fade. And you'll see today, technology was the best performing sector behind gold, which was up 1.6%. So what does this mean? I mean, we saw basically the desire of institutions to hold the Mag 7 companies, why they've done well this quarter. You better be holding them at the end of the quarter. And as a result, they end up selling Staples, which in the last 6 weeks is down 4.79%. In the last 12 weeks is down nearly 5%, the worst performing sector. They had to sell those and own the stuff that is the top performing sector, which right now is basically technology and cyclicals topping the list in the last 12 weeks. Well, why would this create selling? Well, again, there's the desire to hold these stocks up until when? Well, it might just be as we enter the new quarter. So again, individually entering a new quarter, the window dressing going into the end of the quarter, and then the potential selling at the beginning of the quarter as we reshuffle the deck is what we think is going to outperform, doesn't necessarily result in a market decline. Again, a debt ceiling, right? It's not a debt ceiling, but a shutdown does not necessarily generate a market decline. But when you put it all together, sometimes the whole is greater than the sum of its parts. And what we're seeing is that today's representative by the VIX rising with the S&P 500, the perception of risk going into this week, just like we saw last week as the VIX began to rise as the market was rising as well, is that there may be some trepidation, some worry that some volatility may materialize. And that's the hammer, right? Whether it happens this week or not, maybe again, as we approach and we get some sort of government shutdown resolution on spending, as we've seen in recent years, it's resulted in significantly greater spending, which ultimately may be worse for the bond market. And maybe we're about to see the top in the next day or two as we approach that ability to probably get a resolution. And again, spending's generally been the order of the day. So again, greater spending, more potential inflation, all of a sudden, a lack of desire to want to hold Mag 7 companies and wanting to rotate towards more defensive parts of the market like Staples maybe exactly what the doctor maybe have ordered, and maybe exactly what we're seeing. That is the hammer. A stronger dollar, a weaker bond market, again, weaker stock market, and rotation to defensive. If we see anything with regards to gold today, the one-way selling street of the dollar going back to August 22nd and Jackson Hole, as the Fed Chairman Powell talked about, laid out the likelihood of cutting rates. We've seen significant short interest come into the dollar. Do we see the dollar strengthen in that scenario? Well, you wouldn't expect it if we're talking about some massive spending bill. But again, once the cat's out of the bag, do they sell the rumor and buy the news? And now all of a sudden we start to see the dollar strengthen, which creates additional weakness. I mean, the S&P is only up 0.2% today. Gold's up 1.6%. In real terms, the S&P is down 1.4%. Financials overtaken technology today, up 0.5%. Again, in real terms, they're down 1.1%. Again, if we can kind of equate it that way, they're not outperforming gold. And we look at the last 6 weeks, for example, gold has been the strongest part of the market. In the last 12 weeks, gold has significantly outperformed communications, outperformed technology, outperformed cyclicals. Again, what that means is in real terms, the market's declining. We only have the mirage of it going up precisely because the dollar is losing that amount of value. The risk right now is that the dollar actually begins to strengthen. And we're seeing some of that indication. I'm going to bring up SILJ. Not that this is hugely representative, but this is junior silver miners. And what you're seeing topping the list today, and I found this using the Ghost Prince console, we're seeing 22 puts for November 21st being bought, the 21 Nov, 20 puts being bought, the 17 Oct, 2250 being bought. Again, we're seeing bearish interest coming into silver junior gold miners, and silver as well, by the way. So again, are we about to see the dollar strengthen in the midst of all this pressure? That is going to be the hammer for the market, is the dollar strength leading to what? Weakness, as the benefit that the markets receive by a weak dollar is then reversed, and we're seeing gold decline as well as the S&P 500 decline. That is the hammer. And so as we look forward this week, we don't know what's going to happen necessarily. We don't have a crystal ball, but we do know that the risks are elevated. And just like we've seen over the last couple of weeks, the upside opportunity may be there. This is SPX. Let me see if there's take a look here. Any large prints now? But let's look at the SPX, less lines. But the idea is that, yes, we can edge higher, which is exactly what we've done for the last month, edging higher. But the downside risks, again, are elevated. And again, we may see a manifest this week, we may not. But being prepared for a potential sell-off is something we do want to look ahead for and understand, is that eventually the hammer will fall. And again, we have to see the market decline. So we think about there can be only one. There has to be some selling that needs to go on to help the market get on better footing and allow some of these volatility dynamics to reset to help lift it back to the upside and open up some of that upside opportunity. Well, folks, that's what we got for today. Catch you back on next week's video. Have a great one. Thank you.